They falsely believe that if a stock drops 20%, it will simply have to rise by that same percentage to break even, and that's just not the case. What is up, everybody? My name is Adam and welcome back to Broke Man Finance. Today we are going to talk about what to do when it comes to bad stock or bad crypto investments. We're going to talk about what that reinvestment actually looks like when you take that money and you reinvest it. What are some realistic expectations that you're facing, and why having a good defense is the best offense. First of all, just know we have all made bad, terrible investment decisions at some point or another. Even the best investors in the world, some of the most brilliant people in this game, have made notorious mistakes throughout their lives. So don't be too hard on yourself. It's part of the growth process into becoming a solid investor and building wealth. You're gonna take some L's. It is what it is, but it's all good. You are on the right track. If you're watching this right now, you are on the right track, although it may not feel like it. The worst thing you can do as an investor is just bury your head in the sand and say, you know what, I'm done investing, no more, I'm not going to lose any more money. You have to keep investing. A stock can only drop 100%, but it can go up forever. You can recoup those losses. So don't shy away from investing, or you'll never recoup those losses in other investments. One thing I hear a lot when it comes to stocks or cryptos with significant drops in them is, hey, once I get back to that average cost, I'm going to sell out and then I'm going to bounce. Hey, once I get back up to that average cost. People just want to break even and bounce out, which is completely understandable. Then they can move on to something else and all is right with the world. But how long are you willing to wait to get back to that average cost, and what are you losing in that time frame? And at the same time, think about it like this. If a stock has just come roaring back and you have recouped 80% of your losses because it's on a new bull run, well, why would at that moment be the time to sell? You may be getting ready to be proven right all along whenever you first bought in and turn to a profit. Why would you sell in that instance after waiting and holding so long? But what if that stock or crypto never goes back to that original cost? The stock never going back up to the amount you bought in at is a real possibility. It happens. It could have been a complete pump and dump and now you're just holding the bag. As long as your money is tied up in a sinking ship, you are losing the opportunity to make money somewhere else. Are you willing to hold it for 10 years just to break even? That is one of the biggest mistakes a lot of us, myself included, that is one of the biggest mistakes we make as investors, because holding something like that just erodes our overall returns. Especially if something fundamentally has changed with the company and that long-term prospect is now turning bearish, but we're being stubborn and emotional about it. But because we all do it, and I want to make sure this makes sense, let's take a look at the percentage lost versus the percentage rise to break even. You can see the percentage loss on the left and the percent rise to break even on the right. 10% to 11%, 20 to 25, 30 to 43, 35 to 54, and it goes all the way down to 50% loss. You're going to need a 100% rise to break even. A stock that declines 50% must increase 100% to break even. Think about it in dollar terms. A stock that drops 50% from $10 to $5 must rise by $5 or 100% just to return to the original $10 purchase price. Many investors forget about simple mathematics and take on losses that are greater than they realize. They falsely believe that if a stock drops 20%, it will simply have to rise by that same percentage to break even, and that's just not the case. If you look back at the chart, it would need to rise by around 25% to actually break even. Now, that is not to say that every position that you're down in should be sold immediately. I am definitely not saying that. That would be a terrible decision. Although I am no financial advisor, I'm just a guy on YouTube. But there are a lot of plays out there that you may be down on, but there is something about it. There's something about the company, the CEO, that gives you a strong conviction. And in those instances, we should take those downturns, those dips, and use that as an opportunity to buy more and just keep on averaging down. Because when it finally hits, it will make those returns that much sweeter. Another very common mistake that we make is we watch a stock or a crypto just tumble. So we take a chunk of change, throw it at it in hopes that we're going to average down a little bit closer to that new share price. And we got our fingers crossed that, well, maybe it'll hit the new average price. It'll go up enough to hit our new average cost a little bit easier, maybe do it a little bit sooner, and then I can get my money back out. But what happens a lot of times? We throw a chunk of change at it, we drop it down a little bit closer to that share price, and then the damn thing goes down another 20%. We would have been better off keeping our money and just selling the damn stock. Just cut the losses. Not saying that strategy won't work in some instances. It certainly will. I've seen it done. But the majority of the time, if the timing is not perfect, it's going to come back and it's going to bite you more than it helps. On the other hand, what does taking a loss and reinvesting actually look like, and how long is it going to take to get your money back? For instance, let's say you lost 90% of a $1,000 investment and you have $100 left. You sell and you want to reinvest that $100 to try to start recouping those losses. Well, let's say you jump into something that gives on average a 10% every year return, and it does that for 10 years. And I'm not including dividends or any extra contributions. This is what you would be looking at. And if you go through here yearly, you can look at your starting balance and your interest rate and how much you would be earning that year. And if you go down here to the bottom, to year 10, to that end balance, you're going to be at $259.37. Now let's look at a chart that gives an average of 25% a year for 10 years. That's a great investment. Again, you watch that interest level rise, and at that 10-year mark, that ending balance is $931.32, which is almost recouped. You've almost recouped all of your losses at that point. But it is taking 10 years. Now, obviously, getting that money back isn't as easy as losing it, but with the right decisions, it can be done. And if you pick the right investment, those returns can go much higher. And just for shits and giggles, let's look at something that gives an average of 100% over 10 years every single year. So you can see the interest adding up, and at that 10-year mark, look at that ending balance, $102,400. Now that is obviously not the norm and is an incredible investment, but the reality is it is possible if you make the right decisions. Knowing these figures, it is very easy to become impatient. We are a society of instant gratification. We want it back right now. And then we get FOMO looking at these other cryptos that go up 100,000%, and we just start YOLOing our last $100 into some shit coin or some penny stocks. It's not a good financial decision. Again, I'm no financial advisor, but be smart about it, because there is a great chance that you're going to lose even more money by YOLOing into some random squid coin that somebody on YouTube was talking about. And next thing you know, there goes the rug. But if you never want to be in this position to have to do this, a good defense is a good offense. If you're not new to this, then I'm pretty confident that you know what a stop loss is. Meaning, you set your position to sell if the share price falls to a number you're just not comfortable with it being at. And then once it reaches, it will automatically sell those shares. But it really depends on your loss tolerance. What are you comfortable with losing? I've seen stop losses set at 20%, 10%. Hell, I've even seen people put their stop losses at 3%. To me, 3% is too strict. Just with general market fluctuations, you'd be buying and selling all the time. It would drive me nuts. 20% is a little loose for me. I like being somewhere right there in the middle between anywhere from 8 to 10 or 10 to 12%, depending on the play and the volatility within that sector. Or you can always just stay the course and sit tight on those investments and not sell anything. In fact, some of the best accounts in the world were people who had actually passed away or forgot they even had an account and just let it ride for years. But recovering from a stock market loss is going to require patience. I know, it's terrible. Waiting sucks. Ameriprise's research found that financial comebacks often take years. Most of the 3,000 respondents did not recover from their setback until 3 to 5 years later. This isn't surprising given that on average, based on 90 years of history, it takes up to 70 weeks for markets to regain their lost ground. So you're going to have to be patient whenever you're trying to recover money lost in whatever market you put it in. So be patient when trying to recover money lost in the stock market, and you already know the volatility in the crypto world. But whatever you decide, do your due diligence. Go with your gut. Do not get emotional when it comes to this stuff. It's just money. Mitigate uncalculated risk. The uncalculated is the key word. Mitigate uncalculated risk when you can, and you're going to be fine. These things happen. As always, I hope you get rich, stay safe, and we will see you soon.